Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We are also going to jump in and take a look at the U.S. dollar and commodities. And then we are going to have an in-depth look at tech's relative weakness against the S&P 500 and what historically that's meant for tech moving forward. And we will also take a look at the spike in new highs and the fact that there are fewer stocks in uptrends during that time frame. So let's jump right into it here. First and foremost, we have had an ugly 3 sessions this week out of the S&P 500. We had a nice breakout to new all-time highs on Friday, and we saw selling on Monday, Tuesday, and then really ugly action once again on Wednesday. In fact, the market had been trading in a nice range essentially for a month in between that 4,100 and that 4,200 level. We cleanly broke below that. The next major area of support that we would like to see hold on the S&P 500 is right there at that 3,975-ish level. If that breaks, then we would be looking at the 3,850 zone. And if that were to be taken out, that would actually be the first time we have a lower low in play this year. So we're going to be paying very close attention to those levels in on the S&P 500. Now the Dow, same type of thing. Really solid move at the end of last week and 3 ugly days here to start this week off. Breaking below that 33,700 level, which we've stayed above for the last month. Next area of support is that major breakout zone at 32,000. Underneath of that, then we'd have to start thinking about the Dow in a different way. But as it is right now, we still just have a breakout. And even if this thing falls all the way back to 32,000, that would be a breakout and a back test of that previous resistance zone, which could act as support. Again, not great action here over the last 3 sessions in the Dow either, but we haven't broken any major levels yet for the Dow. Now, when we start looking at some of the other areas of the market, charts get a bit uglier. So here is the Russell. The Russell took out the low from the end of April and is headed back down towards the bottom of this range. We have been in that 2,070 to 2,370 level zone here for the Russell over the course of this year, bouncing back up and forth. Headed back towards the bottom of the box. This area really needs to hold. All right, we've got to hold this low zone right in here at that 2070 level. If we break below that, then this range that we've been in trading from the beginning of the year would be broken, and that would not be a good sign for the mid and small cap area of the market. Now, when we take a look at the Nasdaq went and made a new high a couple of weeks back. Didn't put in a new high last week, and you saw that we did on the S&P 500 and the Dow. And then it broke below that key breakout level from 13,360. In fact, when we look at the Nasdaq year to date now, we are only up a little under 1%, right? And so again, let's compare that, the Nasdaq here, year-to-date to the Dow year-to-date. Dow opened all the way up here. We're up almost 10%. That persistent lagging nature out of tech with no real accomplishment since basically last November, we haven't really done much, is not a very good thing historically. In fact, when we take a look at the S&P 500, versus the tech sector, we are now sitting at 6-month lows. So we went from last year, that huge leadership area there out of tech, to we haven't really accomplished anything since last July in comparison to the tech versus the S&P 500, and now we're breaking back below that level while the S&P 500 continues to make those highs. Now, when we look at that, historically, that does not bode well for tech moving forward. When we look at the data set here of the tech sector after the S&P 500 closes at 52-week highs and the tech sector and the S&P 500 ratio falls to 6-month lows, which is what we're seeing right now, tech really struggles here over the next year. In fact, 6 months out, negative more than half of the time, with some really large down draws in here as well. So basically, tech doesn't necessarily resume that leadership role for quite some time. When we take a look at the data set as the tech and S&P 500 ratio versus just the tech sector in that same fashion, 6 months, a year later, it is still lagging the S&P 500. In fact, 3 months out, it's only positive about a third of the time. So these are not necessarily good numbers when you look historically at it for money to essentially flow back into tech. We may continue to see that S&P 500 leadership for quite some time, and we're going to continue to pay very close attention to these ratios moving forward. When we start taking a look at our breadth readings, we can see that the Nasdaq McClellan Summation Index is nowhere near where it was in February. In fact, we're all the way back down to where we were in October, sitting at a negative 200 zone, clearly under the zero level. We've talked about we really wanted this area to hold and to see that breadth reading come back out of the Nasdaq, and that is not what has happened here as of late. And so again, that is not what we really want to see out of the tech space. Even when we start looking at the S&P 500, we had a historic spike to new highs, but we had less stocks in uptrends during that time frame, which kind of speaks to potential buying climax. This is one of those data sets when we look at the market 6 months to a year later, it's positive a high percentage of the time with some really big moves to the upside. But if we look at what's going on 1 and 2 months later, the market tends to struggle there over the short term as we've really kind of put in that big thrust to the upside and without participation across the board, which can lead to some short-term weakness. But because of the thrust that we've had, essentially, it looks good from a long-term perspective. So we're seeing a lot of data sets like this, and we've talked about it for quite some time here, where we just don't have the movement that we'd like to see across the broad market. We've got a couple areas of the market where we've seen rotation into, but now if we're going to see that weakness kind of spill over into the Dow and into the S&P 500 like we've seen for the last 3 days, if that persists, that would be a pretty negative sign for us. Now, let's jump in here and let's take a look at the US dollar and let's take a look in at some commodities. The US dollar, and again, I'll back this chart up to a monthly time frame. We are still sitting at that major level. The dollar has not been strong here over the last month or so. It's fallen back down almost to those lows. It's bounced back up a little bit, but it's still underneath that 91 zone. A move under 89 would be a huge change. As we have talked about, we have lower lows and lower highs still in play for the US dollar, but we really haven't accomplished much in terms of any sort of directional move here this year, so we need to continue to pay very close attention to what's going on. When we start taking a look at some individual commodities, copper did make new all-time highs. It's still trading way up above that zone. We're going to continue to watch to make sure that these levels hold. If we continue to see weakness out of the overall market here, as we've seen the last couple of days, it might spill over into some of these commodities, and they may come back down to earth a little bit. So we're going to watch those key levels on these charts very closely. So for copper, that would be that 450 level. We did see some weakness out of lumber over the last couple of sessions where we made a new high at 1700 and fell all the way back into the 1550 zone. This chart's still very strong. And again, even though we've had a couple of days of weakness here, we haven't broken below any key levels. And so we still look like the potential for some more upside movement there out of the lumber market as well. We start taking a look at some soft commodities. We got corn failing right at that 700 level. I'm going to back this chart up so you can see why we've got that line in here. Right, this is that last resistance zone from back in 2013. We pulled right up into it. We started to turn back down. So if you're paying attention to that soft commodity market, you want to see corn back up over 700. We take a look in at wheat. I'll back this chart up as well so you can see where this line is coming from. Again, that's that 2013-14 resistance level right there at about that 730, and that's right where we've kind of come up and failed. If we look at this from a long-term perspective here, these are some really good-looking potential charts here where you've got a huge multi-year saucer that's in play. A little bit of a pullback and a next move up would be a very bullish setup here. I love seeing these big, long, rounded bottoms over the course of a half a decade. That's where we can get some really incredible moves. So we're going to continue to pay attention to that soft commodity space. right? We look at gold. Gold had a very similar setup where we had that rounded kind of bottom that played out over the course of a decade, and then we've had some really strong action here. And of course, as we know, this to me still looks like a bull flag. I'm going to zoom in here on a daily time frame. Gold has not acted well here for the last 6 months, but it is holding up over 1800. We did put in a potential bottom here right at that major support and at that 1650 zone. I really want to see us back up over that 1880 level. That would give me a much better opinion of gold as it starts to turn around once again. Silver is acting still extremely well, right? If we compare the two of them, gold's fallen for the last 6 months. Silver is still right up near those highs. And back this up and look at it on a monthly time frame there as well, right? We also kind of had that nice long rounded bottom for quite some time, and we've got a nice ascending triangle potential pattern playing out here on a monthly basis. I'd love to see this get up over 30, but it's still holding up nicely. And so while gold has kind of drifted back, silver continues to hold up and is near those highs. That usually bodes well for the space. We come in here and we take a look at Palladium. Palladium made a breakout to new all-time highs, hit that 3,000 levels, pulled back, and this is a very key level if you're watching this market. What goes on right here is important because what we have at the moment right now is a breakout with a potential back test. We want to see this hold right here. If it does, then you'd be looking for those new highs. If it doesn't, then we're looking back towards that 2,500 level. That really needs to hold because it took about 6-8 months to get over that zone. This chart still looks extremely strong up near those highs, and it looks better than platinum does, but platinum still looks pretty good as well. So if we come in and again we back this up on a monthly time frame, that 1300 level is what we really want to see us close over. We had that push in the beginning of the year, right? And if we look at what we've done here over the last couple of months, we keep putting in higher lows and higher highs, so we're drifting higher, but really want to see us break over that 1300 level. That would be very key for that market. Takeaway from today's video, when we take a look at the four major U.S. indexes, we got the Dow, we got the S&P 500 just off of their all-time highs. It's been an ugly week this week, but no key levels have broken down. When we take a look at the Nasdaq, we're almost red for the year at this point in time, which is a 10% lag versus the Dow. What happens over in that tech space is very, very important. Historically, when we see this kind of dichotomy between the Nasdaq and the S&P 500, tech doesn't come back into that leadership role for quite some time. So we are certainly going to continue to pay attention to that. I hope you guys have yourselves a fantastic week. As always, if you want to reach out, talk anything about the markets with me, you can reach me at mtedeschi at perspectivewealthplanning.com, or you can pick up the phone and give me a call at 814-580-9881. I hope you guys have a great week. See you next week.